Hi, I'm Andy Temte, and welcome to the Saturday Morning Muse. Start your weekend with musings that are designed to improve financial literacy around the world. Today is October the 4th, 2025. Over the past few weeks, we've traced the evolution of insurance from ancient Babylonian merchant caravans through medieval guilds to Edward Lloyd's coffee house, where maritime insurance transformed from informal risk sharing into a sophisticated market. Last week, we witnessed how the Lloyd's Act of 1871 formalized this coffee house gathering into a legal corporation, giving it the power to make bylaws and expand its operations. But here's what makes the period following 1871 significant. Insurance stopped being exclusively for wealthy merchants and ship owners. Within a decade, 3 innovations would transform insurance from an elite financial tool into something that touched the lives of ordinary working families. Today, we're exploring how insurance became democratized. Now, picture this. A working-class Boston neighborhood in 1880. It's Saturday morning, and there's a familiar knock at the door. The insurance agent has arrived to collect this week's premium, which is 10 cents for a small life insurance policy that will cover funeral expenses if tragedy strikes. And remember, it was 1880 and tragedy struck a lot. Now, this was called industrial life insurance, and it represented a complete reimagining of who insurance could serve. Before the 1870s, life insurance did exist, but it required annual premiums of dozens or even hundreds of dollars, which was completely out of reach for factory workers, laborers, and domestic servants who earned maybe $1 a day. Companies like Metropolitan Life, Prudential, and John Hancock pioneered a radical new model starting in the mid-1870s. They offered policies with a death benefit as low as $100, just enough to cover a decent burial and spare the family from the humiliation of a pauper's grave. Premiums ranged from 5 cents to 65 cents and were collected weekly by agents who came door to door. This innovation emerged from observing fraternal benefit societies, which were worker organizations that had created mutual aid funds for its members. Remember the mutual aid societies that we talked about last week. But the insurance companies could offer something that fraternal societies couldn't: professional management, actuarial science, and the financial strength to honor claims even during economic downturns. This door-to-door collection system was also crucial. Working families lived paycheck to paycheck with little to no ability to save for annual life insurance premiums. The key innovation was matching payment frequency to wage frequency, where weekly premiums aligned perfectly with weekly paychecks, making insurance affordable and accessible for the first time. By 1905, industrial insurance constituted about 17% of all life insurance in the United States, with Metropolitan Life, Prudential, and John Hancock leading the way. The human impact was also profound. Parents could rest easier knowing that their children wouldn't face destitution if illness or accident struck. The psychological relief of having even modest insurance coverage represented a fundamental shift in how working families experienced financial security. Now, while industrial life insurance expanded downward to reach working families, another revolution was happening at Lloyd's itself. The Lloyd's Act of 1871, it had restricted the corporation to maritime insurance, but economic reality was already pulling underwriters in new directions. The driving force was a remarkable underwriter named Cuthbert Eden Heath, who began his own business at Lloyd's in 1881. As a quick aside, an underwriter is an insurance professional who evaluates risks and decides whether to accept them and at what price. Heath saw what others missed. The same principles that made maritime insurance work could be applied to risks on land. Heath pioneered fire insurance for buildings and contents, solving a critical need in an era of wooden structures and gas lighting. Remember all the whales that were getting killed for whale blubber that turned into the gas for the gas lighting? That's the kind of environment we're talking about. But Heath didn't stop there. He developed what was called all risks insurance for property on land, coverage that protected against any loss that was not specifically included, rather than policies that only covered named perils. This represented sophisticated thinking about risk management. And just a reminder, actuarial science is the mathematical discipline that we introduced in our discussion of Edmund Halley's life tables. It uses statistical analysis and probability theory to predict future losses and to price insurance policies accordingly. Now, perhaps most innovative was Heath's introduction of burglary insurance for households. This might seem obvious today, but it required completely new actuarial thinking. Maritime losses followed somewhat predictable patterns based on routes, seasons, and ship quality. Burglary risk was harder to quantify. It varied by neighborhood, building security, and social conditions. Heath's innovations proved so successful that pressure mounted to formally expand Lloyd's mandate. And in 1911, the British Parliament amended the original act, empowering Lloyd's to carry insurance of every description. The coffee house that had specialized in ships and cargo for over 2 centuries had become a marketplace for insuring virtually anything. This expansion created the template for modern property and casualty insurance. Heath demonstrated that underwriters with maritime expertise could successfully price and manage entirely new categories of risk when they applied rigorous mathematical analysis, the actuarial science that we talked about, and careful empirical observation. Now, the final innovation of this era emerged from an unexpected source, which was technological disruption. In the early 1900s, automobiles began appearing on streets that were originally designed for horses and pedestrians. These horseless carriages created entirely new risks that existing insurance frameworks couldn't address. The first automobile insurance policies appeared in the 1890s, but they were essentially adaptations of carriage and horse insurance. Underwriters quickly realized that motor cars represented fundamentally different risks. They traveled much faster than horse-drawn vehicles, could cause more severe damage, and their mechanical complexity meant new types of losses. Lloyd's and other innovative insurers developed specialized automobile coverage addressing these unique risks. They had to price policies with almost no historical loss data, which is the actuarial equivalent of navigating the open seas without charts. Early automobile insurance was expensive and reflected genuine uncertainty about loss patterns. As automobile ownership spread beyond wealthy hobbyists to middle-class families, insurance became essential. Cities and states began requiring liability coverage to protect pedestrians and other road users from the financial consequences of accidents. This represented another democratizing moment. Insurance became not just available, but mandatory for participation in modern life. So, these three innovations, industrial life insurance, expanded property coverage, and automobile insurance transformed insurance from a niche financial service into a mass market industry. By 1910, insurance companies were collecting hundreds of millions of dollars in premiums annually and managing massive investment portfolios. This creates an important question. Where did all this money go? Insurance companies collected premiums today to pay claims that might not occur for years or even decades. This capital needed to be invested prudently to generate returns while remaining available for future claims. Now, the answer to where all this money goes lies in securities markets, stocks, bonds, and other financial instruments that we will explore in the coming weeks. Insurance companies became some of the largest institutional investors in the world, helping to fuel the industrial expansion of the early 20th century. But to understand how these securities markets worked, we need to go back to their origins. So, until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is the Saturday Morning Muse. You can find the show on all the major streaming services. Please like, subscribe, rate, and most importantly, share this public good with your friends, your neighbors, your colleagues, and maybe especially a family member or two. Oh, and the show is also available out on YouTube. Oh, and the show is produced by the awesome Nick Temte. And we will see you next time.